The Federal Reserve is now all but guaranteed to cut rates, but by how much? Welcome to Market Insight, I'm Thomas Warner. Friday's employment report showed that the US economy added 142,000 new jobs in August, well below the 160,000 forecast. The reading appears to kill off the idea that the Fed will keep rates unchanged when it votes on September the 18th. But will the cut be 25 or 50 basis points? With me to give his take is the Chief Economist at EY, Greg Daco. Welcome, Greg. An extraordinary end to the week, but before we get into all those numbers, do you think that a cut is now absolutely guaranteed?
Yeah, I think the deal is pretty much sealed in terms of a rate cut at the September FOMC meeting. The question now is whether the Fed will proceed with a 25 basis point cut to start its easing cycle, or whether policymakers will favor a larger cut of 50 basis points. I tend to lean in favor of the 25 basis point rate cut because while we have seen a broad-based weakening in labor market conditions, which is what the Fed is focused on, I think a majority of policymakers are still erring on the side of being methodical, being gradual at the onset of this easing cycle.
Well, Greg, the concern appears to be that a 50 basis point cut would look like a panic from the Fed, which they're obviously keen to avoid. So what do you think would actually need to happen over the next 10 days in order to make a 50 basis point cut attractive to them?
Well, we still have one more report that will be quite salient in terms of the Fed's decision, and that's the CPI report that will come out and give indications as to the direction of travel of inflation. What we're likely to see out of that report is some movement sideways in terms of inflation. So if anything, that's likely to make the hawkish members of the FOMC a little bit more conservative in easing policy, and therefore favor a 25 basis point rate cut rather than a 50 basis point rate cut. In the big grand scheme of things, all eyes are still going to be focused on the totality of data on the labor market side. That's really the key area of focus right now. And we're seeing a slowdown. It's not, the economy is not falling off a cliff, but we are seeing visible signs of a cool down in the labor market.
Greg, what do you think the dangers are of the Fed getting this call wrong?
I think the Fed is already behind the curve. I think the Fed should have been easing monetary policy a little bit earlier this year, at least starting to do so, to recalibrate monetary policy to today's economic conditions and tomorrow's expected outlook. Right now, what we have is the Fed that is a little bit behind the curve. We've seen a fairly pronounced slowdown in labor market conditions, with the unemployment rate rising almost 1 full percentage points from its recent low, with payroll growth slowing. And I tend to favor the 3-month moving average gauge of payrolls, which is currently at 116,000 jobs per month, well below trend. Those are indications that the Fed needs to recalibrate monetary policy to bring it from a restrictive stance to a more neutral stance and provide that much more support to economic activity.
It looks like a few board members agree with you based on their comments on Friday afternoon. What do you think it was that caused them to fall off the pace in the first place?
Well, I think we have a bit of a dichotomy within the FOMC members. We have Fetcher Powell that announced at his Jackson Hole speech that he was open to a more rapid easing of monetary policy, or certainly not opposed to larger rate cuts if there were some unwelcome weakening of labor market conditions. But most policymakers are still talking about a gradual, methodical easing of monetary policy. And I think that's where the dichotomy lies within the FOMC. So we're likely to see the onset of the easing cycle be one of 25 basis points. And then if over the coming months, we see further evidence of a weakening in payroll growth, a higher unemployment rate, then that will be a signal that the Fed can ease faster. And I do think the Fed has the room to ease monetary policy faster and neutralize the effect of monetary policy.
Just before we move on to equities, Greg, it does sound that you're virtually certain that it will be a 25 basis point cut.
I'm almost certain, but you can never say 100% in this environment. There's always something that can happen and distort any form of probability. So I would put the probability of a 25 basis point rate cut closer to 85, 90% at this stage.
I appreciate you being willing to put a number on it. Let's turn to equities now, Greg, and it has been a slow start to September so far anyway. How much of a reaction from Wall Street are you expecting to a cut of any size?
Well, I think the main risk right now from a market's perspective is that the Fed underdelivers in terms of easing. Most policymakers are seemingly on board for an easing of monetary policy, one that will be gradual. Markets are anticipating this fairly gradual easing of monetary policy. So if the Fed under-delivers on that easing of monetary policy, you could see a net adverse reaction from financial conditions with lower stock prices and potentially surging long-term yields. That's the negative scenario. That's the scenario in which a tightening in financial conditions exacerbates the slowdown in terms of private sector activity. That's what we want to avoid. So I think the Fed will likely come through with a 25 basis point rate cut at this first September meeting, the onset of the easing cycle, and then proceed gradually, observing how the data evolves, because after all, Fed policymakers will remain data dependent, perhaps excessively so in the current environment.
Thank you very much indeed for your time today. Greg Daco, Chief Economist at EY, and that is Market Insight. Don't forget that you can watch more videos on Reuters.com.